Welcome to this explainer. Look, if you're a finance professional figuring out where to invest your time and money next, you already know that picking the right credential is a massive signal to future employers. So today, we're cutting right through the noise to objectively compare two major heavyweights, the CFA and the CFOA. We're going to dive into their curriculums, the real costs, and exactly who they're designed for so you can make a data-driven choice for your own career trajectory.
Here's our quick roadmap for today. Number 1, the finance credential landscape. 2, deconstructing the CFA. 3, deconstructing the CFOA. 4, a head-to-head comparison. And finally, number 5, which path is yours? Let's get right into it.
Starting off with Section 1, the finance credential landscape, and exploring the modern derivatives boom.
Okay, just look at that number right there, 180 billion. To put that into perspective, global exchange-traded derivatives volumes literally hit a record 180 billion contracts in 2024. That's a massive 39% year-over-year jump. You know, derivatives just aren't restricted to specialized prop desks anymore. They've spread like wildfire. They are now a totally standard part of most institutional investment operations. We're seeing options overlays, volatility management, futures hedging, you name it, being utilized across asset managers, family offices, and multi-asset funds. And naturally, this massive growth is driving immense demand for professionals who actually have specific demonstrable expertise in these exact instruments.
Moving right along to Section 2, deconstructing the CFA, the gold standard for generalist finance.
Now, as you'll see here, the CFA is pretty much the textbook definition of a generalist approach. Check out this breakdown. Derivatives make up only about 5 to 10% of the total material across all three levels. The vast majority of your time studying is going to be spent on much broader topics. We're talking financial statement analysis, ethics, quant methods, economics, equities, fixed income, the whole 9 yards of portfolio management. The coverage of derivatives here is strictly introductory to intermediate. It hits basic Black-Scholes pricing and standard hedging, but it definitely doesn't dive deep into advanced stuff like volatility surface dynamics.
And because of that incredibly broad focus, the CFA is meticulously designed for roles like equity research, broad portfolio management, or M&A. Basically, it signals to an employer that, hey, you have rigorous intellectual discipline and a really sweeping understanding of long-term investment theory across traditional asset classes.
Which brings us to Section 3, deconstructing the CFOA, the specialist credential for listed derivatives.
So in stark contrast to the CFA, the CFOA is entirely focused on just a single domain. Literally 100% of its curriculum is dedicated exclusively to listed derivatives markets. There is absolutely zero allocation to equity research, fixed income valuation, or broad corporate finance. It's a pure, unadulterated specialist credential built specifically to tackle the complexities of futures and options.
Meaning every single topic you're tested on is directly applicable to the actual daily mechanics of derivatives. A full 50% of the exam is just options, everything from intrinsic value, the Greeks, and implied volatility skew, right down to complex trading strategies like iron condors and calendar spreads. Then, another 30% tackles futures contracts and strategies, getting into the weeds of margin mechanics, contango, backwardation, all that good stuff. And the remaining 20% zeroes in on absolutely crucial risk management frameworks and market structure evolution.
All right, let's hit Section 4, head-to-head comparison, analyzing the metrics of commitment.
This factual breakdown right here really highlights a massive structural difference between the two. Earning the CFA is honestly basically taking on a part-time job for 3 to 5 years. It requires over 900 hours of study, can cost upwards of $5,000, and demands a bachelor's degree plus 4,000 hours of professional experience just to hold the charter. Oh, and you have to pay annual dues. The CFOA, on the flip side, is much more of a sprint. It requires about 4 to 12 weeks of study for a single 80-minute, $390 exam with absolutely no prerequisites, no required work experience, and 0 annual dues.
So what does this actually mean when an employer sees these on your resume? Well, they get very different signals. The CFA proves a really strong, broad financial discipline. But honestly, two charter holders might have completely different actual capabilities when it comes to derivatives. The CFOA, however, signals a formal, highly specialized assessment. The employer knows, without a doubt, that this specific candidate truly understands the exact mechanics of futures and options.
Okay, final section, number 5. Which path is yours? Mapping credentials to career mandates.
Now, a really important takeaway here is that the CFOA is not just for pure derivatives traders at prop firms anymore.
Because as we discussed, derivatives are now so deeply baked into broad finance, this credential is highly relevant for multi-asset portfolio managers, risk officers, or frankly, anyone managing options overlays within a traditional institutional portfolio. If you are overseeing derivatives positions or covering structured products, it delivers incredibly focused, practical utility.
So given these really distinct tracks, a logical question you might be asking yourself right now is, can you hold both credentials?
Well, the data shows they're actually complementary, not competitive. They really serve entirely different markets. A CFA charter holder who's moving into a derivatives-heavy role might absolutely pursue the CFOA to signal that specific domain expertise their broad CFA designation just kind of doesn't convey. And conversely, an independent options trader who already holds a CFOA might decide to pursue the CFA if they want to transition into a much broader, generalist investment management role. They work seamlessly together.
The overarching takeaway today is crystal clear. Generalist credentials simply don't certify specialized knowledge. As you sit down to plan your next big career move, you really need to ask yourself, does your future rely on a broad understanding of all asset classes, or do you urgently need to prove verifiable expertise in the specific, complex derivatives driving today's modern markets? Match your credential to the exact instruments you will actually manage tomorrow